Hello viewers, thank you once again for tuning in. I'm your host, none other than Mr. Spotter Fred. And we want to continue doing what we like doing most. And don't forget, we like doing advanced financial management. So we like this. And you've noticed as we meet and as we frequently meet, you've noticed that they're becoming easier. Advanced financial management is becoming more friendlier. Now, today we want to do something slightly different from what we did last time, and this is corporate valuation. This is a new topic, corporate valuation. Corporate valuation. That's a new topic, corporate valuation. Now, corporate valuation actually deals with valuing a company, valuing a firm, valuing an enterprise. Knowing what the value is, what is how if we want to maybe acquire a company, we want to take over a business, what will be the market value, or what will be the value of that particular company, or if we want to sell, we want to merge, what will be the value of that particular company. That's what corporate valuation is all about, that we want to determine the value of a firm, the value of a company, the value of shares of a company. That's what we refer to corporate valuation. There are various methods, deals with valuation or determining the market value of a firm. There are various approaches that we can use. There are various methods that can be used to value a firm. One, let's say methods of corporate valuation. Methods of corporate valuation. One is economic value added. This economic value added is simply the EVA. Economic value added, very important, a very important one. Then we also have the enterprise value. Enterprise value method. This is EV, enterprise value method. 3, we have use of free cash flows. Use of free cash flows. Use of valuation models. Valuation models. Now these valuation models, one will be Gordon's dividend valuation model. And let me say A. B, we have James Walter model. We have Lintner dividend model. Right? Those are some of the main areas that we'll be looking at. But we have many other valuation models that we don't want to go into. But these are the main ones. The Gordon's dividend valuation model, James Walter model, and the Lintner dividend model. These are the main models that we'll be looking at. Now, we'll want to start with the economic value added. Economic value added. The economic value added. Now, what is this economic value added? An economic value added is a measure of a company's financial performance based on the residual wealth calculated by deducting its cost of capital from its operating profit, adjusted for taxes on a cash basis. Economic value added can also be referred to as economic profit, and it attempts to capture the true economic profit of a company. This measure was devised by Stan Stewart and Company. Now, economic value added is the income generated by a company net of the investor's required return on capital. We have various steps. We have said that this is the profits generated, the true profit generated by an entity. The true profit generated by the entity. We have various steps of how we can use the economic added steps. Steps used. Step one. Under step number 1, we calculate the adjusted capital employed. Calculate the adjusted capital employed. The adjusted capital employed. What is this adjusted capital employed? The adjusted capital employed, this is equal to equity. That is the adjusted capital. Equity is the ordinary shares. Equity is the ordinary shares and reserves plus the goodwill. We may have goodwill plus goodwill, right? Remember, goodwill can be purchased, or goodwill can be valued. So we have goodwill. You also add provisions. You add any other provisions like depreciation, provisions or provision for bad and doubtful debts. Then we also add the debt written off in the statement of financial position. So this is debts written off. That is how we determine the adjusted capital employed. Remember, friends, when you talk of equity, it's simply the ordinary shares and reserves. That's the equity capital employed. So first, get the adjusted capital employed. Then we calculate the net operating profit after tax. That is our step number 2. Step number 2, calculate the net operating profit. Let me say that. Net operating profit after tax. This is NOPAT, right? So we calculate NOPAT. How do we get the NOPAT? We simply need to take into account the operating profit. And we add the interest expense and we subtract the taxes. So the net profit, the NOPAT is equal to operating profit before tax. We add back interest expense. Then we subtract the tax expense for the year. That is how to get the NOPAT. That they calculate the net is the net operating profit after tax. So we add back the interest expense, then we subtract the tax expense because interest expense is a tax allowable item. That is how we get the step number 2. Then we move on to step number 3. We calculate WACC. Step number 3, calculate WACC. Remember, WACC is equal to the weighted equity plus the weighted preference share capital if you have it, plus the weighted cost of debt, 1 minus T if you have it. That's the WACC. But you should also know that for unlevered farm, WACC of unlevered farm is equal to the KEU. That is the cost of equity. Cost of equity. If it's unlevered, we only have equity. If you only have equity, then the KE will be the same as WACC. That is our step number 3. Step number 4, we now multiply the WACC with the capital employed. So step number 4, determine the return on capital employed.